Hello and welcome to Switzer. I'm Peter Switzer, and with reporting season over, I've asked my experts to give me the stocks that they like or dislike as a consequence of running their eyes over those companies that have gone out there and done a show and tell. Giving their best views will be CMC Markets' Michael McCarthy, Berman Invest's Julia Lee, and FN Arena's Rudy Philippek Van Dyke. I'll also ask Charlie Aitken and Paul Rickard to give us their best ideas on how they're investing right now. And finally, Rod North will tell us what the investment clock is saying about the overall market going forward. Is a crash pending? So without any further ado, let's go to Julia Lee of Berman Invest and Michael McCarthy of CMC Markets. Thanks for joining us, guys. Now, I sent you an email today asking you to do something for the sake of the show, and being the gracious person you are, Julia, you've actually followed the script.
Anything for you, Pete?
And what I want to do is stocks that you might want to buy as a consequence of a possible trade deal, or ones that you would have if there was a trade war was escalated and so on. Right, agreed? But then Michael McCarthy, a friend of mine, just basically said, no, I don't want to do that. So tell us why, Michael.
Well, Peter, apart from my natural spikiness and contrariness...
Is it because Manly's doing very badly in rugby league at the moment?
Season's over, Peter.
Okay, right.
Move on. No, because I don't think it's the key strategic approach at the moment.
Okay.
This is the gift that keeps on giving for Trump. This war is too valuable for him. This dispute is too valuable for him in domestic political terms. And just as Bush waged a futile war on drugs for great political purposes, Trump's done exactly the same thing. These trade disputes are open-ended, they're ill-defined, there's no clear goals, there's no clear end. And because they're so valuable to him politically, I think we better get used to it, Peter. I think we're going to be seeing these at least until November 2020 at the next presidential election.
What do you think, Julia?
I mean, the great thing about the markets is that you can be 100% correct and still lose money, and that comes to the timing aspect of it. So look, I think there's a 60% chance that we will see a trade deal before the US presidential elections next November. In the meanwhile, you know, we're sort of treading water, and the key question, I guess, is what do you do from a strategic point of view in the type of environment we're in?
Okay, so in a sense, you have justified his use of strategically looking at the whole situation.
I have an answer to that, Peter.
Okay,
what do you do?
Yeah.
People complain that there's nothing cheap in the market, right? And we know that value investing has underperformed over the last 2 years.
Shocking.
Does that mean value investing is dead? I don't think so, Peter. And I note that there's a number of names, something like 18 in the top 200, that are trading at around 50% of the share price we've seen in the last 2 years.
Are you going to give us all 18 as well, Mac?
I'm going to give you a handful of them. Well, one of them was today's
You'll only get it here.
One of them was today's top performer, the lithium miner, Orocobre. About 6% today. Now, it has plummeted from above 750 to around $2.
It wasn't a darling at one stage.
It was. And the lithium story is not over. There's certainly an oversupply at the moment. But if you want to be a value investor, you don't get top stocks trading at rock bottom prices. They're at a rock bottom price for a reason. And in all of the stocks I'm looking at in this, investors have to make up their own minds, Peter, whether or not they think this is a good company going through temporary troubles or it's something that's terminally wounded.
Yeah, give us another one before we go to the girl who did her homework.
Well, there's two that we'll talk about because they could be related to trade war news, and that's Platinum Asset Management, trading at around half its share price.
Yeah,
just
it's had a real hard go lately, hasn't it?
It certainly has. And Adelaide Brighton Cement. Now, this stock has plummeted once again. It's around 1/3 of its price for less than 12 months ago. And there are plenty of reasons not to buy these stocks, Peter, but they're the reasons that I'm looking at.
Okay, Adelaide Brighton clearly hasn't been helped by the fallen house prices and the housing construction area. But we're starting to see the loans starting to come back and the auction clearance rates. Maybe they'll start building in 6 months' time.
Well, this is the thing, Peter, and if this trade war drags on and we're looking at a very low growth scenario for Australia and the Reserve Bank keeps calling on the federal government to stimulate the economy, the place to go is infrastructure.
Okay, the place to go was Victoria once upon a time, but okay, infrastructure. Okay, the girl who did her homework, let's keep going.
Well, I guess you can divide it into the period before a trade deal is done and the period after a trade war is done.
Yeah,
at the moment, you know, we are seeing growth being impacted, and the impacts of that is falling interest rates, possibility of stimulus coming through down the track, and the weaker Aussie dollar. So the way to play it at the moment is through assets which are not limitless. So things like, I guess, property would be one area that you could potentially look at. High yield, given that we are seeing interest rates falling. Infrastructure type of stocks like Sydney Airports and Transurban. I guess in the dividend yield area, I do have a few favourites.
Okay,
I did come prepared. I guess looking at real estate has rallied, especially in the office and the industrial space, quite severely over the last couple of months. So some smaller players, you've got Charter Hall Education, which looks at the real estate for things like childcare centres. Arena's the same type of company. They've got yields of around about 5.5%. In the office area, there's one called Servcorp, which is the virtual office, or you take a stake in an office that has a yield closer to about 6%. Even Macquarie Group, which has a great ability to adapt to different conditions, has a yield of around about 5%. And look, this reporting season, we saw those salary packaging, the novated leases type of companies doing well. Macmillan Shakespeare still has a yield of around about 5%. So there's plenty of things to play with if you are looking for yield in that area. Of course, once a trade deal is done, it's all about growth. So high beta stocks, just look for the growth.
Okay. And what's your favourite growth stock after a deal? What's the one you say, I want to be on big time?
Well, you know me, I do still like some of the technology-based stocks. And look, some of the biotechs are looking interested. This reporting season, we saw Nanosonics doing extremely well through the distribution that they have over in the US. And I think one of the unusual things about Nanosonics is the amount of money it does spend on research and development. So in the area of infection control, it is about their pipeline of products. So hopefully there's no delays, because that would be a negative, but hopefully we'll see a new product launching in the next 18 months.
Mecca, what else you got to offer before I say goodbye?
Well, I'm still in the value space, Peter, and I'm used to being ridiculed. At the beginning of the year, I kept raising retail stocks. Lovisa, all-time highs. JB Hi-Fi, all-time highs. Woolworths within $1 of all-time highs. Coles at all-time highs. Over that 9-month period, I like the banks too. So
you also got a 7,000 call out there as well, out there with me.
Wow, that's
I remember that.
Year's not over yet, Peter.
I know it's not over. But a trade deal would help us look really smart people.
That would make us look a lot better. I agree with that, Peter. But I'm still looking at those stocks that have been hit hard. Now, we've already mentioned before Challenger Financial, we've mentioned Costa Group, we've mentioned Speedcast. Add to those that we talked about today, Platinum, ABC. I think there's a real case, or a Cobra if you like. Once again, investors have to decide whether or not these are quality long-term businesses. But if they do, those share prices are incredibly attractive. And defensive doesn't just mean an earnings profile. It's a function of share price. And a stock like Woolworths, despite the fact that it's got defensive earnings, I would argue is not defensive at the current share price. At $38, that's not a defensive investment. So I'd be looking for value. I think that's the shift that investors could make to really juice up their returns over the coming 12 months.
I'm not sure whether one of you or both of you at one stage mentioned the stock Pro Medicus.
That was my stock pick in September last year.
Yeah, and the owners sold off last week. But what's your view on the company, despite the fact that the owners sold off?
It's still doing extremely well. I think last year in September, it was my recommendation at the small and mid-cap ASX companies.
And you probably mentioned on my TV show as well, that's why I remembered it.
Yeah, but I can't remember what the price was. But you would have made hundreds of %, if not thousands of % in that time.
You're good. She's good. Hundreds and thousands of %. All right, one last thing. Your view on the Australian economy, and would these value stocks benefit if?
Don't point to me for value. No. I don't have the ability to sleep at night.
Okay. But if the economy rebounds stronger than expected, and there are some economists who say that, would you expect value stocks to respond as a consequence of that?
Generally, when the economy rebounds, what you see is a pickup in spending. So that's what I would be tracking. I'd be tracking the money and looking at the discretionary retailers that would be looking to benefit. And look, they've been sold down because the housing market has had a dampening effect. One of the retailers I do like is Accent. We are seeing, I guess, a casualisation of the workforce where you don't have to necessarily wear your suits as well as the work shoes anymore. You can wear...
Come on. Show the shoes she's worn. Can the camera go down? Yeah, look, have a go at that. I've never had anyone wear. What are those shoes? There's like toes there as well.
There's a sole as well.
Yeah, they're cute. Are they for running or just for walking?
They're just for walking. I had to walk from the other side of town to get here.
Okay. So we're very adaptive in the Switzer program.
AXI is a stock code.
Okay.
AX1
and
is a stock code.
there's a company called Accent, ACCENT.
Yes, that is the Accent, the shoe company.
Okay, great.
Yield of 5%.
Okay. Last one, value companies and improving economy.
Well,
Peter, what's going to get them out of their,
Peter,
their funk?
we're not going to get an all clear. But what's become very clear over the last 2 years is the momentum trade has become very crowded. From 2013 to 2016, it was the only place to be.
Yep.
And hedge funds all around the world jumped in. In 2016, we found out what happens when momentum reverses. Yeah. We get a panic, and we've seen 2 of them since then. And I think that means, and the poor returns that a lot of those hedge funds have had over the last 2 years, means they're looking for new ways to look at the market. Yeah. I suspect they're going to go back into value. Another reason to be there. And because investors won't get the all clear, they're going to go for those things that are easier to buy. That means lower share prices. Okay. So, yeah, the place to be, I think.
Roger Montgomery would be glad to hear you talking about value on the way back. That's Michael McCarthy from CNC Markets, Julia Lee from Berman Invest. We're coming up after the break, and we'll be talking to Rudy Philippek Van Dyke, and we'll ask him about how he's playing the trade deal / war. Welcome back, and as I said earlier, we've got Rudy Philippek Van Dyke, the founder of FN Arena, and I want Rudy to give us the stocks he likes and dislikes as a consequence of reporting season. Great to see you, mate.
Well, it's mutual. It's mutual. Rudy, I said. Peter.
Yeah. You notice I've brought back the old redoubtable Rudy Philippek Van Dyke.
I noticed.
I think one night I did about 5 hours in a row. I'd worked out all these hours that emphasise the greatness of Rudy Philippek Van Dyke. That's enough of me praising you. Let's get back to why you're here. Yeah. Let's start with the big story. A lot of people are worried that there won't be a trade deal. I'm arguing I think there will be, though I'm not a psychiatrist or a psychologist. I'm just thinking that he needs one to avoid a big stock market sell-off and a recession. Therefore, I think he'll go for it. What do you think? And if you do think a trade deal is going to happen, what do you think would happen to the stock market? If there's no trade deal, what do you think will happen?
Well, I think we will not have a trade deal.
Okay.
Not because Trump doesn't want one. I think the Chinese are now past that. They don't want one.
You're always different from me. I don't know why I bring you on the show. But go on. Yeah, no trade deal.
And it's very difficult to predict sentiment and what will happen next. And I think the logical observation to make is that this year again there's more money flowing out of U.S. equities than in. Most fund managers and other strategy pieces I've been reading in the past few weeks, they've all been increasing the cash holdings.
Yeah, big cash holdings.
And the observation is that the market keeps on powering ahead. It's again at, well, not quite yet, but it's again not far off from all-time highs. And that contradiction can last as long as a piece of string. I mean, we don't know. Having said so, it's probably not a time to be very complacent about things, but I don't think also that we will by definition have a sell-off simply because September, October is a dangerous period. I mean, it doesn't have to be. And we'll have to see. But I don't think there's a trade deal coming. There's lots of dangers out there.
Ever?
Well, ever maybe is a big thing, but I think if the Chinese have
before the election,
that's what I'm thinking. I think if the Chinese have a chance, they probably will play their cards to get Trump not re-elected, and they might have a stand a better chance. Having said so, I think this is also one of the conclusions that came out of the reporting season in August. I think we should maybe necessarily focus on Trump and China. We should focus on the domestic economy. And a lot of companies, as proven in August, are doing it very, very tough. One of the observations that definitely stands tall in August is that we are increasingly facing in a share market where the companies that are in good shape, that continue to grow their profits and continue to be good for shareholders, is actually shrinking as a pool. So we're getting an ever shrinking pool of companies that continue to perform well, and that in itself, of course, is that means we don't have a lot a lot base, and then that's itself.
And are
a
their
danger.
share prices being bidded up because
Absolutely.
they're the only game in town?
Yes, and that's obviously the consequence of that.
Okay.
But
And do you worry about that? That one day they might say, "Okay,
a little bit,
take
yes.
profit table."
A
then we go.
little bit, but again, I mean, people have been worried about this for the past 2 years, and time and again proven wrong. I mean, a lot of those companies. I mean, just to pick one example, well, you can pick a few. You can pick a stock like REA Group or Wisec Global or Altium or CSL or ResMed. The times that I've heard that those share prices were due for 50% fall or something along those lines. I mean, if I got a dime every time, I would be a millionaire now. But those share prices,
very American.
The old-fashioned one. Huh? But the conclusion is that those share prices have never been higher than today.
Yeah.
And I mean, they've been powering on.
But that's your argument, that the good companies, people chase them, and they probably have been bidded to too high a level because they want to play other stocks.
But also there are very solid fundamental reasons for that, because they are the ones that also operationally continue to perform.
If I was prepared to say that when it comes to your analysis of companies, you know, you're absolutely brilliant. I may well be exaggerating, but still.
He's not. He's not. He's so not.
But when it comes to the economy, you know, you're not always right. Like most people are. It's a hard one. Are you thinking that the Australian economy is not going to improve enough over the next 6 months or 12 months to help those companies that are struggling?
Yeah, I'm not making the prediction. That's my fear.
Yeah.
Yes.
Okay.
And I was at the conference just before the reporting season, and I heard a few economists, and they're cautiously optimistic. Yeah. But my message to investors was, don't take investment advice from economists. Listen to the companies. And if you listen to the companies in August, it was pretty. It was pretty tough. Right? On a lot of metrics, like we do a lot of data. I mean, I'm not the only one. Goldman Sachs does it, UBS does it, JP Morgan does it. On most of the metrics, we have not seen a reporting season as bad as August. Right? Now there's two ways.
Gee, that's a headline you didn't use even on your website.
Well, I said it's probably the worst one in post-GFC, and most of the data doesn't go further. I mean, that was actually, Goldman Sachs reiterated that this morning. This was the worst reporting season they've seen post the GFC.
But it does also coincide to, you know, 2 pretty ordinary quarters of growth as well, doesn't it?
Exactly. So it's actually been backed up with economic data as well. Yes. So there's now 2 views that you can take the view like, okay, it's so bad, it's the trough, or it's. And I look at the trend, and I see the trend deteriorating in February. February was quite not that good. Coming back from August last year was much better.
The February reporting season.
Yes.
Just
February
decoding for normal people out there.
Yes, February reporting season. Then you have the reporting season in between February and August, where we also have companies.
Small number of companies.
Yeah, but still, and that wasn't good either.
No.
And then you get August, and August was bad. So if I look at the trend, and in particular if you compare to August last year, then the trend is definitely deteriorating.
Okay.
I mean, so it's nice to speculate on a rebound, but the rebound so far is not there.
Okay, but if you look at the background of all those bad periods, I call it really the shortened slowdown. You know, you had all the scary policies.
The guy gets everything over him.
But you scare a lot of people. You know, negative gearing, capital gains discount, all that sort of stuff. You had house prices dropping, and that's the thing that shocked me more than anything. That, you know, we had Susan Mitchell, who's the CEO of Mortgage Choice, on our podcast, and she shocked Paul Rickard and myself about 6 months ago when she said 1 in 5 people who used to get loans weren't getting loans. So I thought that has to slow the economy down. But we're seeing that turn around now. We're starting to see house prices come back. Yeah. Let's say this then. If you see the economic picture for the economy going, say, from 0.5, which was the last reading, which was better than people even expected, up to say 0.8 in September and even higher, would you then think there's a chance that those companies related to the economy would start showing some improvement?
It can. And for investors, the challenge is then to figure out whether it's a short-term one-off or whether it's something more
short term,
or whether it's more sustainable.
Yeah.
Right?
Okay.
And that's always the challenge.
Okay.
And that's also the question mark. Because, for example, one of the standout sectors in August were the retailers. Yeah. But then some of the retailers, very important. And then obviously the question is, why are the retailers? And maybe some of that tax
Starting to trickle
refunds
through,
is
yeah.
already coming through, yeah, and there's more coming.
Yeah.
But then obviously the question remains, what passed? What passed that?
Okay.
Is then the housing recovery enough
Yeah.
to keep
Okay,
retailers
time
going?
out on the highbrow stuff that you and
Yeah.
I love to do. Let's get to the more important thing. A lot of our viewers want stocks you like and stocks you don't like. So ones you like.
Okay, here's the broader picture.
Yep.
This is the dilemma for investors. Yeah, the laggards. It's usually people try to pick up the laggards because they think there's less risk and there's more potential for upside.
Yeah.
In August, those were the ones that disappointed. More profit warnings, more disappointments, more share prices selling off.
So the worst got worse.
On the so-called cheap side of the market.
Right.
Yeah?
Yeah.
Post-August, we already had 2 profit warnings, Internet Pivot and CYBG. Those are not highly priced companies. Yeah? So the irony here is that the laggards have a lot of operational risk. So you have to be careful in jumping on a stock like Pioneer Credit or Amazon or even Virgin Australia. And then obviously the good performing ones, well, that's the market knows that. They've been picked up.
Yeah.
So you have to find a balance.
So WiseTech, we missed the boat on WiseTech?
Well, I would not chase them here, but I'm a shareholder, so and I'm constantly in that dilemma. Do I take something off? Or do I wait until it gets until it pulls back and I buy more?
Yep.
And I mean, there's lots of them. There's Altium, there's CSL, there's ResMed, there's Zero. I mean, they haven't even reported yet. There's, I mean, so there is maybe an opportunity in companies where you go, like for example, Bapcor, where you go like, well, the market is simply being stupid here.
Yeah, and you like it,
and of course, and then they come out in August and they have a good result, and
Yeah.
the share price is a lot higher. I mean, so one of those companies that I own is Aurora.
Yeah. And that's been
And I've been a long-term fan
Yeah.
of Aurora, and I intend to stay a long
It's a
time on
packaging
board.
company. Yeah.
Yes, it used to be Amcor in Australia,
Yeah.
or Australasia here. That's now Aurora. I think the market is
Wrong.
well wrong, maybe right for the time being, but way too harsh.
Okay.
Right? So I don't think that share price will stay there eternally.
Aurora, yep.
Although investors might have to be patient for a while because
Okay.
they're disappointed in August. You know?
Okay.
All the other ones, I mean, I'm still a big fan of the CSLs, the ResMeds, but maybe at these prices you don't want to chase them.
No.
But my advice to investors is, see, those companies, reporting season after reporting season, they prove that they are worth investors' attention. Yeah. So maybe what you want to do is you just keep a list of them, and then when something happens, like maybe
A crazy sell-off.
the last 4 months of 2018, for example, then you know which stocks to buy. And you don't buy the Amazons and the Pioneer Credits.
Yeah.
You buy CSL and ResMed and REA and the likes.
Okay, good stuff. Rudy Philipp Van Dijk. As always, giving us the insights that are really worth listening to. Rudy Philipp Van Dijk from FN Arena. Welcome back. Well, our continual desire to try and work out what's going on and how we should invest brings us to my regulars, Charlie Aiken of Aiken Investment Management and Paul Rickard of the Switzer Report. Guys, Rudy Philipp was on, Van Dijk was on my last segment, and he doesn't think a trade deal will happen before 2020, the November election. What's your view, Charlie?
Oh, I tend to agree with that view, but that doesn't mean there can't be a ceasefire, Pete. I don't think it necessarily gets any worse after October. They may agree to, no more new tariffs. The tariffs that are on stay on. Just remember, the US Treasury is collecting $258 billion per annum now on these. If the full tariffs kick in, that's half the US defence budget. I mean, there is actually a benefit to America for this. But I personally believe in a bit of a ceasefire after these upcoming talks, but I don't believe there'll be a trade deal imminently.
Paul?
Look, I think there'll be some type of arrangement that will allow Trump to declare it as victory, game over. Look, whether the Chinese...
And the market will go up on that.
Yeah, well, look, he needs a win, and look, he's pretty good at telling tales, whatever he wants to make it.
Rearrange reality.
Yeah, he'll remake reality, so he'll declare it as a win somehow. I mean, I think the Chinese are playing a long game. I'm with Charlie there, but I think there'll be some type of truce or ceasefire. He'll be able to get up and move on and say, look what I've done. I've saved all these jobs. The economy's booming, and here we go again.
Charlie, as a consequence of that analysis, what is there a stock that you've recently picked up on the basis that this stock is going to do well in the kind of environment that you're predicting?
Well, I mean, the kind of environment I'm predicting is the one we're sort of in right now. You know, very low interest rates, slightly volatile markets moving up and down with Twitter tweets, and you know, and I'm just trying to find really good long duration businesses that aren't that cyclical, that are still going to grow at sort of 15%, 20%. So we haven't really changed anything in the portfolio. This period, I've actually done very, very little in the portfolio. Just trying to stick to our knitting. So,
have you added anything of the stock?
I'll tell you one thing I am actually looking at in Australia is actually a company called Goodman Group, the industrial, industrial
which
warehouse.
Which is a company that would do well for fulfillment.
World leader in what it does. Biggest clients, Amazon. Just fell about $2 a share on an index, getting thrown out of some index. Right. So that's the sort of thing I'm looking at. I haven't bought that one yet, but trying to really good businesses. It's got low gearing, 9%. Just something that might be an opportunity in a market like this. So I'm not taking any huge view on anything other than good businesses. Let's just stick with good businesses.
So what you do is you keep looking through various companies. You see how reporting season might have treated them. If the market's overreacted, you then test it so there's any good value to hold this for a longer term.
To a degree, let's try and you want to own the best things you can, and sometimes the market gives you a chance in a stock you haven't owned. I haven't owned Goodman Group; it's been a very good performer. Just pulled back a bit in recent days and recent months. That's just the sort of thing that comes to our attention. We'll do some work on it, and it might just add up that that's a good idea. But at the moment, markets have had a good bounce, on hopes of a trade resolution. We've got a lot of central bank action in the next few days. The Central Bank of China just lowered the reserve ratio for banks in China. It's like a rate cut. You've got the ECB this week, then you've got the Federal Reserve the week after. There's a lot of central bank action too. So I just want to keep it pretty calm.
Okay, Paul, you always get annoyed when I say give us a new stock from reporting season because you said I gave you 3 stocks last week. But have you got a new stock from reporting season?
Well, I nominated last week CSL and WiseTech. I'm not brave enough to own WiseTech, Peter, but it's gone up about another couple of dollars since last Monday. Okay. So it keeps going. It just shows you the power of momentum. And I think it's also just how desperate people are for things that have a plausible growth story.
Agree.
I think that also means there's a trade-off to that. Of course, yield players can afford to be a little more patient. So growth can't go forever, but that's the current noise out there. Look, for the thrill seekers, Nanosonics is one. It's up about another 10% on last week's result. It's got a great product out there, allegedly a second product coming out, Peter. Market's very bullish on that. It's for the thrill seekers, right? So a good solid company, single product. Who knows whether the second product's going to work or not? But there's stocks like that. So look, I think there's, coming back to where you started, I think you can. I think one thing that is very clear, and coming back to what Charlie says, is that yields aren't going up. Sorry, interest rates aren't going up. They're staying low. Yield stocks are going to get bought, and they got a little bit too far. They've come back a bit. I think you're going to see more interest in some of the more classic yield stocks. I think Australian banks are in that category. Much as people like me and you have been saying that there's not much growth there, but the yields are still damn attractive.
Well, just remember, the yield stocks have no growth and the growth stocks have no yield. So that's how it works. So don't expect too much growth for the yield stock.
And I think you can afford to be patient. There's a lot of noise, right? If you look at the market, really hasn't done a lot net terms over the last couple of months. And I think this noise is going to continue. And I think you can afford to be patient.
Okay. Is there a thrill seeker stock that you got?
Not really. I'm just not really in thrill seeker mode at the moment. Sorry to disappoint people. I think this is a time to be very sensible. I think there's a lot of unknowns out there. I think if you've got a stock in your portfolio, I think you want to be rock solid on it. That it's a good business, you understand it, that it's reasonably valued, good management and reasonable prospects. So I'm not really looking to add thrill seeker stuff at the moment. And there's plenty of thrill seeker stuff out there. But I think that I just want to keep it. I'm more like looking at something like a Goodman Group, right? Where I think if I get that right and it turns out to be right, I might be able to make 20% out of that. And that's good enough. That's thrill seeker enough when the alternative in the bank is 1%.
And you do say if you're going to buy something in the industry, buy the best. And Goodman Group probably is the best in that industrial space. Isn't it?
That's just an example of sort of thing I'm looking at. I don't want to go right up the risk curve right now because I'm just not exactly sure what comes next.
Well, talking about being lower on the risk curve, Paul, the banks, what are they yielding with franking credits?
Well, you still get 6% yields pre-franking credits, Peter. So it's
really
almost
not a bad bet
grossed up. Look, The dividends are pretty safe. Westpac might have a little dividend cut. It probably needs to, but I think you can say both National Australia Bank and ANZ and the CBA now in the safe category.
Yeah.
Not exciting. I mean, the market got quite excited today on the back of some housing finance numbers. First time I could ever see the market react to housing finance numbers.
Well,
but it does show you
they are
how
rebounding.
It does show you also how there's a dearth of information, but also there's people are finding it difficult to say buy this, sell that.
Yeah.
And I think that does tell you the noise is sort of winning out.
Well, I think it's people need to alter their return expectations too. I mean, if the alternative in the bank is 1% on deposit, or a bond is 1%, or a US bond's 1.5%, you need to lower your return expectations. Getting 5 to 8% total return out of the share market is pretty good in that scenario, and maybe 5 of that's dividend yield. So starting with a good sustainable dividend yield is a
Switzer dividend growth
Switzer
fund,
dividend growth fund, which we all
11%.
sit on. Start with a good sustainable dividend. That's a damn good place to start.
And the banks are that example. They can keep paying 5 or 6% dividend yields, and the price does nothing.
Yeah,
That's fine. That's okay.
That's okay. So, I mean, and that's really what they have been doing in the last 12 months.
a very nice piece of observation. That's Charlie Aiken from Aiken Investment Management, Paul Rickard from the Switzer Report. And coming up, we'll be talking to Rod North of Bourse Communications. He's looking at the investment clock and where he thinks the time is telling us that there is not a crash coming. Hello and welcome back. I'm talking to Rod North, who is the founder of Bourse Communications. Rod's been a stalwart in the industry and also has a very interesting product that can predict when the stock market's going to go up and when it's going to go down. Rod, thanks for joining us.
Thanks very much, Peter.
Now I say that, of course, it's always difficult to do those predictions, but let's just position you first.
Yes.
What does Bourse Communications do?
So Bourse Communications looks after companies. We nurture them from sort of sub 10, 20, 30 million up to a couple of hundred million. So we like to pick small cap companies that have got really good growth prospects. Some of them are in industries where we're seeing some significant dynamic changes as well, and they're challenging a lot of the sort of major companies as well. So we quite like a whole range of sectors in that respect.
I've never thought about asking this, but what is the one company that really has shot the lights out, that you started off on the ground level and saw it go?
Absolutely. It's a company called EML Payments. It sort of started out its life about 7 or 8 years ago, backdoor listed through a gold company that just didn't have any luck and find any gold over in WA, and then it became Adept Solutions, then it became eMerchants, and then EML. And it is absolutely textbook in how to grow a company from sort of sub 20 million. And it's interesting you should ask that, because it was only last Friday that they clocked in at $1 billion. So we got very excited about that. And they've grown their business because they've acquired businesses overseas in other countries as
now
well.
Before you got into Bourse Communications, you had a history in the industry. Tell us what your track record is.
Well, I sort of bought my first shares at the age of 9. Father was a stockbroker for 40 years, so I worked in stockbroking for quite a few years, then into funds management with a company called Union Fidelity, which was Trust Company of Australia, as a fund manager there. Then I decided I wanted to get to know a bit about properties. I worked in the property industry for a company called Brick Securities, that you might recall, did a lot of property development. And then for 8 years was with First State Fund Managers that ultimately got taken over by Colonial and grew the business there from about 200 million to 1 billion to 10 billion, and they manage about 100 billion. So that was a pretty exciting journey. Colonial First State.
Okay, so, but I got to know you because you used to put out your version of the investment clock, which you can see on. And my first conversation to you, I reckon, would have been after the GFC.
Yes.
And there were a lot of people trying to tell us this was going to be a sort of double dip back into stock market collapse and all that sort of stuff. And fortunately, you agree with me. That wasn't the reason why I brought you on my TV show, but it was nice to see someone who did. Tell us about why you got close to the investment clock.
Well, it was in share broking in the 80s, before the 87 crash. I found this just piece of paper basically which had an investment clock on it, and it was actually one that appeared in 1937 in the Evening Standard. And I thought, well, this is quite interesting. And I quite liked the whole sort of idea of cycles and all that. So it wasn't until years later that I thought, you know, I have to revisit that, found the old bit of paper and then thought, well, you know, we might just have a bit of a look at this and see if it actually does help people with their investment strategies, and then decided to make it dynamic, create it into a clock that actually, you can go on the website and it's interactive as well, so it actually shows you. It never used to be. It was a static thing, you know, back obviously in 1937 when it first appeared in London. I spent quite a bit of time trying to actually find the original Evening Standard document, and I'll probably have to go to London and do that myself. I paid hundreds of dollars for someone to research it, and they unfortunately didn't find the page, but I'll do that one time. And it basically, you know, follows a series of cycles, you know, which can be applied both to the share market and property, you know, about sort of levels of expectation of where things are going to go and where you sit in those cycles and perhaps what you should do.
And even though it is portrayed as a clock, and it's also good then that a certain time is a worrying time, another time is not so worrying. I like the idea of that. But the reality is, when I used to teach economics, I used to talk about this goes with this goes with this. I call it Suzanne economics, you know. But that's what it basically is. There are steps that, and often they're linked to interest rates, and that leads to various assets becoming potentially popular or unpopular. So why don't we just, in a nutshell, sum up as you go around the clock? It's just in big lick terms.
Well, it's quite interesting because when we first chatted, you know, back in 2008, 2009 and the GFC, well, of course, the share market spectacularly dropped from 6,873.2, which was its all-time peak in November 2007, down to 3,109 in March 2009. So that was actually a really good time. So in terms of working around the clock, you know, we came out of the boom phase in 2007 and moved into the slowdown and potentially,
hold this up.
potentially
this is where
into
we
the recession
were
phase.
Before the GFC.
Yeah, before the GFC.
This became the slowdown.
The slowdown through 2008, 9, 10, right through. Amazingly enough, there's been a lot of talk about Australian recession, and amazingly enough, Australia's been lucky. We've dodged the bullet on that one for 28 years.
The Americans had the great
The Americans had the recession. So sometimes you can move around the clock quite quickly, or you can be stuck in a particular phase, or you can even go backwards.
Some bands can be longer, and other bands can be shorter. And
they can be. They can be, and everyone has their own view of, you know, sort of where we are. I'm pretty clear now. Obviously, we came through the recovery phase, which was sort of companies like, you know, EML Payments as well, that have grown, you know, their franchise, made acquisitions and grown organically as well, and they've benefited from that. And, you know, I think, you know, we've moved into this boom phase because we've seen, you know, property prices go up, we've seen interest rates come down, easier money still seems to be happening, with the potential for maybe another 1 or 2 interest rate cuts.
Well, as Templeton says, you know, a bull market dies in the euphoric stage.
That's right.
And I think the Americans are more in the euphoric stage than us.
Yes, they are.
I think we're kind of getting it. We're kind of still in the mature stage, would you?
Well, I think we are. I think we've still got a bit of a way to go because, you know, we've had a whole lot of other sort of macro factors. Like, it amazes me.
Royal Commission as well.
Royal Commission, and the fact that, you know, John Howard was the last Prime Minister to serve a full term as PM. I mean, who would have thought that 12 years ago in 2007? And here we are. We don't know, you know, hopefully the current Prime Minister might serve out a full term. And I think all that backdrop means it slows us down.
And there was also a mining boom come off the boil in the middle of that.
That's right. The mining, and then what we've seen, you know, just in recent times, sort of last May this year, you know, when the election occurred, and, you know, there was some certainty that perhaps came into the market with the government. And, you know, we've seen a couple of interest rate declines since then. And, you know, often people say to me, well, you know, what should be happening at the moment? Well, if you can't make $1 in a low interest rate environment as a business, you're probably never going to, because go back to sort of 1991 and in the early 90s, we were paying 18%. So I think there's a real sort of opportunity for the share market to still rise above where it's been.
And a lot of people watching this would like to know, do you think, looking at the analysis you've done, but because ultimately the US market has to keep going forward, because Wall Street will call the tune.
Yes,
and even if we have a lot of potential momentum to go higher, if Wall Street crashes, and I think that if a trade deal doesn't happen, that could lead to a crash. what's your best guess, given the fact that you've been doing this a long time?
Well, look, I think one of the key things that I've done is when you study the history of the share markets over 145 years, every time the market has reached and then surpassed its previous high until just recently. So from 2007 until now, it's taken 12 years, and back at the end of July, we actually reached the all-time high. And then I thought I better do an analysis of the last 145 years and actually see what the market increased beyond that.
How long does it go and how much does it
go
above the
Exactly.
It's quite significant, isn't it?
Quite significant. It can be up to 30 or 40%. So, you know, we got there and we dropped back a bit over the last month or two. But interestingly enough, and a lot of people thought, oh, you know, I've gone crazy. I've, you know, predicted I think we'll see the market reach 7,000 by the calendar year end. Well, a couple of weeks ago, we're sort of 400 or 500 points away from that. But today, we're only about 40 or 50 points away from
I
reaching
also
that.
have made that mad claim, and we're going to need Donald Trump to help us get there.
We will need Donald Trump to help us get there because I think with an election in November 2020, as you know, you'll think that Donald Trump will really want to do a trade deal. He'll want the US economy to looking pretty schmick. And I think once, you know, we see that market, you know, into next year, with the economy perhaps looking still pretty good in the US. We've had friends who've come back and said there's lots of job ads everywhere, even in the back of cars. So, and I think if Americans are asked the question, do you feel better off now than you were 4 years ago? And if the answer is yes, that probably means Donald Trump might get a second term. But I'd be a bit nervous beyond 2020 into 21, 22, because often, you know, after a US election, you do see markets reverse. So I think we've got a pretty good, clear picture between now and then, though.
If this October trade meeting ends badly and Trump escalates by raising tariffs, do you think the chances of a significant stock market sell-off and possibly a recession would be the likely outcome?
Well, I'm punting that I think he'll do a deal because I see this, interestingly enough, as art of the deal versus art of war, you know, where you've got Trump and you've got Xi Jinping both battling it out. And I think ultimately they will do a deal. But I think Trump really perhaps doesn't want to do a deal this year. He probably wants to carry it into next year because it's probably be more beneficial if he resolves it in 2020 than 2019. But yes, there's always the danger. That's probably the black swan event. And that can happen and it can take us to, you know, a whole other level.
Okay, one last question. When people have asked me to explain the investment clock to them, one of the most important variables in how we go from coming out of a recession and getting into a boom, and when that boom ends, is interest rates.
Yes.
And historically, at this part of the cycle, investment clock, interest rates would be high and going higher.
Yes.
That's and when people say to me, you know, how can you say this time things are different? This time things are different.
Things are very
You've
different.
never seen it.
No,
I've never seen it.
No.
Do you think the fact that interest rates are so low, it could actually stretch out this boom period? It might not be a massive boom, but this could be a long boom.
It could well be, because I mean the reality is we've got a cash rate of 1%, with the potential for that coming back to maybe half of 1%, which would be just unbelievable in many respects. But what will happen is that will drive more money into the share market, I think, because people will be chasing yield. But the biggest concern that you've got to have in the boom phase, which is really important, is that's often the greed cycle of the market as well. And people can get a bit carried away. Valuations of companies go through the roof. People often throw fundamentals out and say PEs don't matter. Well, yes, if a company's on a PE of 40, 50 or 60, yes, you have to worry about it. And you've got to look at the fundamentals as well. But if we're in a boom phase, which I believe we're in, you've got to be very careful about that. But I think it will carry on a bit longer.
Well, watching the market and telling people to be careful is what we do around here. Thanks
Very
for joining.
good. Thanks very much, Peter.
That's Rod North from Bourse Communications.